Let's cut through the noise. You've been told your whole life to diversify. Don't put all your eggs in one basket, spread your risk. Buy a little of everything and you'll be safe. But here's the problem. That strategy worked in a world that no longer exists. Today, diversification has become one of the biggest traps in finance. What used to be armor is now just painted cardboard. And if you don't understand why, you're the one holding the bag when the system cracks. Here's the battlefield reality. Passive investing and diversification aren't safety nets anymore. They're chains, pulling entire generations into the same collapse at the same time. Let me break it down. Once upon a time, diversification was simple. You bought some stocks, some bonds, maybe a little real estate, and if one sector tanked, the others cushioned the blow. That made sense when markets weren't fully synchronized and when information moved slower than today. Back then, you could hide in bonds when stocks burned, or in cash while everything else fought it out. That world is gone. Today, passive investing dominates. Trillions are parked in index funds and ETFs that move together like a herd. And when the herd runs off the cliff, you don't get to stand safely on the ridge. You get dragged right over the edge with them. You think you're diversified because you own 500 companies through the S&P 500. But here's the kicker. They're all being driven by the same currents, the same interest rate policies, the same liquidity pumps, the same AI-driven trading systems. If the Fed sneezes, your diverse portfolio all catches pneumonia. Let's get tactical. Look at 2022. Stocks collapsed, but bonds collapsed right alongside them. That was supposed to be impossible, remember? Bonds were the safe haven. Diversification doctrine said one would balance the other. Instead, both went down like dominoes. Same story in tech sell-offs. You don't just lose one company. You lose the whole damn sector because every ETF, every 401k, every robo-advisor is tied together like soldiers with their boots in quicksand. So why is this happening? Because diversification has been weaponized. What started as a strategy to spread risk has become a tool to funnel retail investors into being the exit liquidity for Wall Street. Passive funds aren't designed to protect you. They're designed to guarantee that your money props up the indexes no matter what. You're not hedging. You're subsidizing. Think about it. When everyone owns everything, no one is protected. Diversification has become the camouflage Wall Street uses to hide systemic risk. They say, you can't beat the market, just buy the market. But here's the ugly truth. If the market tanks, your diversification doesn't save you. It just means you lose in every direction at once. That's not risk management. That's suicide by spreadsheet. And this is exactly what the elites want. It's easier to control a herd that all moves the same way. Index funds make you predictable. Predictable means profitable. For them, not for you. You're not an investor in their system. You're inventory. So what's the play? First, stop worshiping diversification as gospel. It's not. It's just a tactic, and like all tactics, it has a shelf life. Second, start thinking asymmetrically. That means building positions where your upside isn't capped by the herd. Small, deliberate bets in areas you understand. Skills that print money even if markets burn. Cash flow that isn't tied to Wall Street's mood swings. The ability to pivot when everyone else is stuck in a trench. Here's a practical reality check. Real diversification today isn't about owning 500 tickers. It's about mixing asset classes that aren't tied to the same puppet strings. That might mean owning hard skills like coding, design, or even trade work that earns no matter what. It might mean real assets, cash-flowing property, niche businesses, or even knowledge products. The key isn't to spread yourself thin, it's to spread yourself smart. Now, I'm not telling you to go full kamikaze and dump your ETFs tomorrow. What I'm saying is stop pretending that blind diversification is going to save you. It won't. The battlefield has changed, and you either adapt your tactics or you get taken out with the first wave. And here's the real kicker. The system will never admit this to you. They'll keep chanting diversify because it keeps you docile, predictable, and easy to bleed dry. Think about the illusion they sell you with that colorful pie chart. Stocks here, bonds there, a little international, maybe some real estate sprinkled in. It looks safe, balanced, professional. But peel back the chart, and all those slices are wired to the same power grid. When the lights go out, the whole city goes dark, no matter how many slices you thought you had. Here's an example nobody talks about: international exposure. They'll tell you to buy a global ETF so you're diversified outside the US, but half the companies in those funds still live and die by the American consumer and the dollar. You think you're hedged by holding Europe or Asia, but when the Fed hikes rates, the whole planet gets whiplash. That's not diversification, that's a shadow copy of the same risk. Or take real estate investment trusts. The REIT's Wall Street pushes like candy. Supposed to diversify you into property, right? But look at what happened when interest rates jumped. REITs got crushed right alongside bonds because they were both chained to the same rate environment. Different wrapper, same poison. Now here's the real dirty trick. Correlations between assets aren't stable. They change under stress. It's like soldiers who look brave on parade day but panic when the shooting starts. Stocks and bonds can look uncorrelated in calm times, but the minute a crisis hits, correlations spike to 1. Everything sells off together because the herd panics together. So the time you need diversification the most is exactly when it abandons you. That's the part of the playbook they never show you. And this isn't just theory, it's history. Look back at 2008. People thought they were safe owning diverse mortgage-backed securities. Except every one of those slices was tied to the same housing bubble. When the bubble burst, all the slices detonated together. Or look at the COVID crash in 2020. Oil, stocks, real estate, corporate bonds, they all dropped in unison. Investors thought they had lifeboats, but really they were just standing on different parts of the same sinking ship. So let's drive this home. Diversification today is theater. It's risk packaged as safety. It's the financial equivalent of body armor made out of cardboard, looks good on parade, worthless in combat. And if you don't question it, you'll find yourself bleeding out wondering why your protection didn't stop the bullet. If you want to actually win, you have to see through the lie. You have to ask not just who's lying, but why they're lying. And the why is always the same, because your money funds their survival, not yours. So here's your recap. Diversification worked when markets weren't a synchronized herd. Passive investing turned that herd into a single point of failure. The lie is that diversification spreads your risk. The truth is, it just spreads your losses. And the only way forward is to stop thinking like a victim and start thinking like a combatant. If you're tired of being the exit liquidity, stay tuned. We're dismantling every one of these financial lies, one by one. Next up in this wall, the boomer homeownership lie that keeps you poor. Subscribe now and load the next round, because this fight has only just begun.